Welcome to the #1 marketing podcast. I'm owner Haas. This is the HasMedia Podcast. I'm with my co-host and brother,
Okan Haas.
and we got a special guest for you, Nick Fusilli, right? Fusilli?
Yeah, you got it.
All right,
Just like the pasta.
All right, so Nick is in real estate and also was previously an accountant, right?
Yep.
And so how'd you get into the real estate space, and kind of take us through that and how you started?
Yeah, so I ended up getting into it. I was always interested in it. Like, whole life, always loved the aspect of being able to buy, like, oh, I can buy this asset, and then learning on the accounting side, you learn all the tax benefits from everything. You learn that it's kind of just a part of the puzzle that you want to have at some point in your life, because you can put money there and it's essentially going to grow tax-free. Mm-hmm. And you have plenty of tax benefits to play with it with borrowing money. Because if you borrow money, you don't get taxed on borrowed money. Mm-hmm. And that was just one of the big things to see for it. And then you think, oh, well, there's so many different ways to skin that cat of real estate. So we started with, we bought a rental, had someone go in it, they paid the mortgage, we made, $1,400 a month. And that was just our first one that we bought. Incredibly cheap, just kind of went with it. And then we started looking at short-term rentals, which now all of a sudden it involves a little bit more work, but now you're making, $60,000, $70,000 a year from one property instead of, $12,000, $14,000 a year from a property. So went there and then kept leveling up and moved up to commercial real estate and got a couple holdings there and realized that those really, once you go to this triple net, which is a triple net basically just means you're responsible for the structure and the roof, and everything on the inside of the property is the tenant's responsibility, as well as, they're paying their fair share of the outside maintenance as well. And you just get less phone calls. Cash flow is more predictable. Mm-hmm. Rents go up every year. Well, if you write the leases that way, which the majority of them are. And we just my wife and I fell in love with that model versus the rest of them, because we started seeing that from finance and accounting, we don't mind those singles, doubles, and maybe the occasional triple. It's just you're looking at it and you're seeing these are predictable. We understand our expenses. You don't have to worry about, like in multifamily, like we've been involved in asset management and everything from all over, not just our holdings, to learn more about other asset classes.
Gotcha.
And in multifamily, if the taxes go up or insurance goes up, that can absolutely kill your investment in 1 year. Where in triple net, you look at it and it's like, oh, the taxes and insurance went up. Well, the tenants are paying the taxes and insurance, so it doesn't affect your bottom line.
So there's a lot less risk, I guess, involved with that?
I wouldn't say a lot less risk, because if let's say you have 10 stores, and if one leaves, it hurts a lot more than one tenant in a 100-unit building. So it does. There's risk reward in every piece of real estate.
Gotcha.
But that was just what we liked more about it, because generally, if you have a really good business in there and you're talking with those businesses, you're having a good relationship with them, if they're doing well. Mm-hmm. You can tell by the foot traffic if they're doing well. And if they're doing well, then you're going to have a better tenant for a long time.
Gotcha.
And generally a mom and pop shop, or even a big commercial retailer, once they're in a place, they've done their research to be there, especially the big tenants. The big tenants have all types of data that they've looked at to be like, I want to be here. And when they look at that, they go, okay, well, they have their whole demographic picked out. They've enjoyed, I can't say enjoyed, but let's say, let's say it's like they have their demographic picked out. They know where there are other locations in the state. They're like, I want to be here.
Gotcha.
So once they're in there and they're operating, they're making money.
What usually predicts that okay, I want to be here? Is it other, I guess stores around there, or is it like, what I mean?
It can be neighborhood, demographic, income, as well as other locations of that store.
Gotcha.
So when you see Starbucks, Dunkin' Donuts, or say a chain grocery store or retail store, it's going to be, well, I have a location over here in this county. okay, I think I could have one here
sure.
because it's a similar demographic.
That's why there's usually like, when you see certain stores, there's always that other store right next to it.
Some just follow.
Yeah.
Because they work well together. So
That
it's
makes
like,
sense.
you're also thinking about the thing that's nice about strip centers is that it's a different game of looking at it. Like, you pretty much get to put the pieces together of looking like, okay, well, I have a nail salon, I have a pet place, I have let's say fast signs in my case for the opportunity I'm looking at now, and a grocery store and a restaurant and a kids academy. It's like, what else is going to work in there? Well, a PT place could work there, or a doctor's or a dentist's office could work well there, or a law office, or anything else that's a recreational, like a golf simulator, even a laundromat or something like that could be a great tenant for that
Gotcha.
center.
Do you think like the strip mall, right? There's a lot of talk about malls in general dying. Like, how do you look at a strip center and go, okay, like this is a moneymaker, and what's happening in the market right now that people are saying like, oh, no one's going to malls anymore. No one's, there's no more foot traffic there.
The mall model is much different than the strip mall. Like, you want to look at things that are servicing the community. And if something's servicing the community, like a pizza place, or like I say, a nail salon, hair, like any of that stuff, grocery store or a kids academy, PT, like those are servicing your community. Your community has needs for those services. If you have those needs, the community is going to continue to back them. If you offer a good product, you'll stay in business. And that's the kind of stuff that is really, to me, being able, like predictability, being able to offer really good returns, and being able to really match what you're modeling out. That's what I fell in love with more triple net and the strip centers, and even standalone. But standalone, it's only 1, 2, 3, little different. I do enjoy the mixture of having
100%.
Yeah.
And I think too, like strip malls in general, it's kind of coming back a little bit.
I agree. It's definitely, if you look at who's going after it, it's a lot huge barrier to entry. You got to really understand a lot of things before you go into that.
Right.
And it took a lot of hours.
Yeah. Do you think having a accounting background of how you started and your dad's firm as a mechanical engineer?
Yeah.
So having that mechanical engineering understanding and doing the accounting for that, and does it give you an edge over the other competitors that you have?
Like, you seem like you're like a numbers guy.
Yeah, and that was, I can't really, like, you don't want to like talk down about anybody on this, but it's like there's a lot of other people that are in the market that they don't have that accounting, finance background, tax understanding, what documents got to go out, timely reporting, timely K1s at the end of the year, and how impactful that is on people that you're investing, as well as understanding when you're putting projected financials, taking a lot of things into account is where, my wife and I, coming from, it's not even really like working in the small business from accounting. It was more like when I was working in corporate, working with corporate leases, and where, you see the difference in the leases in which location, New York City versus a one in the middle of the country, very drastically different leases, terms, prices, everything. That really, like, having the understanding of the accounting and finance has been huge, especially from the modeling perspective. Like, my wife and I really focused on doing just underwriting for a while, and even helping other investors and working on other teams as underwriters and asset managers. And that's where we kind of learn that's where we want to be at, because a lot of deals fall through, like a lot of things fall through the cracks if you don't have good asset management and underwriting, because that's really just strong financing and accounting at the end of the day.
Yeah, without that, I mean, it seems like it becomes like super, I guess, stressful, because you don't know how to manage it, right? It's just, am I on the right track there?
Yeah, no, like that's like 100. That's 100% correct. But it's like, at the same time, there's so many other things that go into. It's not just financing and accounting. It's also understanding how to negotiate with a seller and how to negotiate with tenants to get exactly what you want, but understanding the financing and accounting behind it, where it's like we can go out and offer some sort of, you know, different terms or maybe a seller financing option, or not that, you know, anyone can go put a deal together, but it's the story and the journey of how you got there and actually putting numbers behind the whole journey, not just throwing it out there. Like you could go ahead and just be like, hey, I got this deal, it's under contract, like I'm going to raise capital for it. But how good are your numbers? Or like what things did you take into account? Because if you go to our underwriting, you see that we're stressing deals on top of, you know, not just vacancy repairs. Like we're putting random vacancies in there, even when we have tenants with leases for the whole time, just to make sure we're stressing our numbers in case someone leaves.
Right. It's like proving the numbers so that there is no objection, essentially.
Like our concept is, you know, not that, you know, you love to under promise, but it's under promise, over perform. And that's how we've done all of our modeling for anything.
And do you look at every scenario possible? Is that kind of how that works?
Yeah. Like you're basically running this, looking at it as like, if I lose my biggest tenant, is this actually going to go under or not? Like that's, you're looking at it from that perspective as well, where I personally don't prefer the centers where you have 70-80% one tenant. Even though that tenant is most likely never going to leave and it's very reliable, I do like the smaller mix. That's a personal preference. You know, just from me looking at them.
What do you look for? So this property in Princeton, why did that one stick out to you guys, and how did you come across that?
Well, one, we've known where it is because it's down the street from my wife's parents. So it's only 10 minutes away from my wife's parents' house. So we've actually been by that plaza a lot, and it had been vacant. And the guys before us had bought it, renovated it, and started the lease up, but they're moving their operations over to New Mexico right now. So they just wanted to get out of the area. So they're like, all right, well, the project's almost done. They'll make their return, but they left a little meat on the bone. And we had the opportunity brought to us off market, and we were working on it since last August. Went through the process. There was a couple things that had changed in the deal while we were under contract, and we had to renegotiate with the sellers. And finally, conveniently after I had a newborn, was when they started coming back to us. But no, it was all good. We got back on the same page, because with these deals, like, you got to realize most of the time you're basically sitting at the 5-yard line, and that's your disagreement. It's not, people think, oh my God, this is so big. It's really not. At the end of the day, you just got to get close enough to where someone's going to reach over and shake your hand. Like that's it. So we got close finally, and then we were able to re-amend, and now we're back on track with this opportunity. And at the end of the day, it ended up, working out for a couple extra percentage in our favor. Awesome. But it's a win-win that's the thing. You have to look at a deal to make it a win-win for everybody. You don't want to go fleece somebody, to steal their property.
Absolutely.
At the end of the day, I'm not going to sleep, right? Unless they're doing it to themselves. Like, if they're in a situation where you're taking something at a discount, that's fine. But if you're just doing, fair transactions, everyday market, everyone's got to win. That's how, brokers got to win, sellers got to win, the buyers got to win, investors got to win. If everyone wins, then you have a good deal.
It's a successful project.
And that's where we were very happy to be able to bring this to market with. You think about it, like, my wife and I were going through our underwriting books, and we're talking underwriting. We're not talking deals that we did a quick sheet on. We're like full underwriting of where we were in the process of negotiating on. We've been doing this. We had almost 100. We were just under 100 deals before we actually got one that we were happy with to commit to, bring to market.
Isn't that the rule of thumb? Go through 100 rules? I've heard that.
That's the lead. Yeah, a lot of them say, you send 100. It's like 100 leads come in. If you can convert 1%, you're good. So that we basically hit that.
Yeah, same with it's funny because that same rule applies with the media space and the marketing space. It's record 100 videos until you you just start doing it yourself or whatever, and then or write 100 emails before you start doing marketing for email. It's just interesting that like that kind of you got to be in it. You got to understand how it works, right?
Yeah, and I mean it's our first opportunity of this scale, you could say, but at the same time, it's like we've done countless other projects, smaller, medium size, and this one is larger, but it's still like our real estate we've continued to not lose on. We continue to just get better and better and better at it. And it is the direction that we wanted to go to be able to offer this. But the advantage of the real estate space is, like I was saying before, you can do it in however you want. I can bring an offering to the table and I can say, hey, you know what? This is how I want to offer it. And once you can, you gain traction with investors, they get used to it, they enjoy that. But anyone can do it differently, but it's the same thing in the media space with you guys. Like you guys will have a different approach for podcasting, short form, and everything when, it's different tastes for everybody. So as long as I can appeal to people that way and not be, I'm not coming in here with a private jet and all other stuff. That's not.
You're trying to build a foundation, though.
Yeah, like foundation.
And you're saying that there's no one size fits all.
No, there's absolutely not one size fit all. Like you'll have investors that love in and out transactions. They want to invest with a group that is doing fix and flips or something that's a little more risky, like a developmental project, but the returns are there, but it's a quicker timeline. The stuff that I'm looking for is generally 3 to 7 year turnaround time, because what's really good with the triple net is that you have that built-in rent increase, or you're going to put a couple tenants in, get your bottom line really big. Once you get to that next step, what happens is then that's all your gain. So that's where you get those really good returns, is you let it, you got to let it cook for a couple years, and then you get your spread, because your debt's going to stay. You get fixed rate debt, even if it's fixed rate for 5 years, which in commercial, you'll get fixed rate for 5 a lot. They won't fix a rate for 30 years generally, or 25. So they'll give you a fixed rate for 5. If you can perform in that 5, every time your rents go up, your expenses
stay the same.
It's all the same. Your expenses are debt, basically, or a vacancy. So you're just building, and then you get that bigger gap. Now you can go sell it.
Gotcha.
Or you can refinance, pull the money out, pay all your investors, and everyone's happy, and then you just continue to cash flow.
Nice.
That's crazy.
Mm-hmm.
So
that's the risk right there. So you're going. I'm sorry, I didn't mean to cut you off, but that's like you're going in. It's like the debt is that risk factor essentially, right?
More or less.
And then for like ease of, I guess,
lack of better term.
Yeah, lack of better term. And then once that price starts to go up and you start to go into that green a little bit, that's when you start to see, okay, now this is kind of flowing in cash, and you can keep doing that essentially.
Yeah. So with real estate, what's great is that you have your natural cash flow, you have your appreciation of the property, and now the other side you don't see, it's like depreciation of the property as well,
right.
Which there's different things that you can implement to accelerate it or not, which if you're doing a 5-year hold, it is beneficial to accelerate your depreciation. And you have that, as well as you're still kind of fighting inflation with holding an asset, and everything is backed by the asset, which I have always enjoyed is from other investments, that it is backed by a physical asset. You can literally drive up, you can be like, hey, I'm a part owner in this in this real estate, and you can just drive and you can go to those restaurants, you can go to the other services that are there, and you can touch the building.
Right, it's tangible.
It's a tangible asset, which is different than some of the other worlds. Not that we don't love XRP or Bitcoin, but it's a little less risky from that perspective. But you got to look at it that way. It's a slow and steady wins the race with real estate a lot of the time. You're not always going to hit home runs, but there are some people that absolutely crush it. You got to hats off to them. But our risk reward level, this is where it's like we kind of know that our general return rate is anything that we pencil is going to be from 18 to like 26% IRR, which is just an average. You're basically just looking like, hey, that's what the rate of return is going to be on a yearly basis. That's kind of where we're at.
So going back to that fixed debt ratio, that debt that's being paid over 5 years, like the debt, or what happens after the 5 years?
So if they do a fixed debt for 5 years, there's a different options. It depends on the loan.
Mm-hmm.
So if you, let's say, we'll just go standard, 25-year commercial loan. So it's amortized over 25 years. Every 5 years, the rate adjusts to what the market
Gotcha.
is. So it's your amortization table just changes to the new debt rate,
Gotcha.
either up or down.
Okay. And then so you just have to, and that's why the rent increases is crucial, because when you get into that 6th year, now it's like, okay, we need to be at this certain level because we got to play with the debt.
Yeah, well, the debt, you'll know where the market is usually about a year or so in advance.
Mm-hmm.
And at that point is usually where you can kind of think about, hey, are we going to try to refinance into a better term, or, or just go with the rate adjustment?
Gotcha. So that was another question I was going to ask is New Jersey is super competitive, especially in the real estate game. I hear a lot of people saying, it's hard to find a deal. If you get into a deal, it's very little in the returns that you get. What do you look for? Because I know like the 3 main things is usually the foot traffic that's coming into the door, but that doesn't always mean that it's going to turn into sales for the client, or for the clients and tenants in that space. Location is huge, right? And then the financial is, the projections are big, right?
The one that's big is, it kind of goes with location, but it is demographic.
Okay.
You want to look at the scaling demographic in the area where it's like if you pulled the data for where I was looking in Princeton, other than the fact that we kind of already knew from being right there, it was, you saw over the last 10 years the growth of the average household income.
Mm.
Growth of average household income is a great number to look at because that's more disposable income.
Gotcha. Makes sense.
They're going to use the services that are in the strip center, which benefits the strip center and the tenants in the strip center.
Gotcha.
So the community kind of, you're looking for a good community to essentially allow for the asset to thrive.
Yeah, so that's a great term to kind of put it as, is like when you're putting a strip center or buying a strip center, you have to look at how does it service the community, and how does, like, if you're viewing it as that is fuel for everything around it for, we'll say, 5 to 10 miles, depending on the density of the population. Mm-hmm. And also, where is the next strip center and how does that service it? So you're kind of looking at the map that way as well.
And how do you, is there a way to kind of, I guess, figure out what is most needed in certain areas?
You can sit there and do all your due diligence. It's like you're sitting there, you're pulling all the charts, you're looking at, okay, these are the 5 closest strip centers, this is their tenant breakdowns, and you're kind of just you literally are just going through each one and looking at, hey, how close are they? It's like, that's how you start looking at stuff. It's literally like grocery store, academy, like where is the next one? And you're just breaking it down that way and kind of going through everything.
Do you ever, because we have family in the restaurant game, do you ever offer, or do you have seen investments offer like percentage of sales as rent?
I have seen that.
Mm-hmm.
That is, I've seen it more in very, very main street, high, like traffic areas of where they'll say, hey, we want to work with you, but at the same time, if you're growing, we're growing rent. We're always going to be like a fixed, I don't personally agree with it.
Yeah.
And that's coming from the landlord side, but also a person who owns small businesses as well. It's like, why am I giving a piece of the pie? But generally when you see those, they're helping you with build out. They're helping you grow as well because it's mutually beneficial.
Yeah.
Gotcha.
So it is, I won't say mega common, but I have seen it a good amount, especially in super high traffic, like beach areas or like Main Street in a huge area where they're like, hey, like we're going to work a profit sharing, but it goes, they're working both ways.
Because I just had an idea too, is like on the marketing sense, because we do obviously a lot of social media marketing, advertising, you name it, like web development and all that stuff. And like, why wouldn't a landlord, not expect it, but try to work out something with all the tenants in there to get their marketing on mainstream to drive traffic to the actual strip mall itself.
And that's something that, you know, that's on our operationals list, where people are like, oh, like, well, what are you trying to do? Like, that comes down to the operator. And that's where I've seen a lot of the holes in triple net, where you could say it in any market, honestly. Like, it's just, you have a lot of mom and pop runs operations where you could just tell because it's not clean. If you look at a strip center and you drive into it and it's got nice paved, nice lines on the parking spots, lighting, clean everything, good landscaping, and there's no trash around, now you kind of know that's going to have a better operator. Well, what if that operator turned around and had a landing page, doesn't have to be a complicated website, say, hey, this is what is, you know, at this strip center, or this is my holdings, this is what's at this location. And that's kind of where we're trying to go, is like, as the younger group going into this, is we can add that dynamic of, like, you know, incorporating with you guys or something, like working in, hey, like, and then maybe you do like a tenant highlight, you know, you do a one around on all the tenants when you get a new center, and just do like, hey, we're going to highlight your business. This is on the landlord. It's not you. This is the landlord coming to, you know, work together and kind of help you guys. And like, that's how our heads were going with getting into this industry, which is just a different dynamic to look at it versus some of the old school people that are just like, hey, how much money can I possibly make off of this? And
100%.
I am not spending money on landscaping or...
Because it's more money for you in the long term.
It is.
That's the crazy thing, because I see a lot of these, you know, you have a restaurant that's like crushing it, right? Because we have a friend that is going to come on the podcast too, but we went to his restaurant. It's a small little spot in Manalapan, and they crush it, and they're in a strip mall. But they're driving so much traffic to the strip mall. Like, why wouldn't you want one or two businesses in your strip mall to win, you know?
Or all. Well, why don't you want all of them to win? Yeah. Like, that's the point. You know, it's like, and that's where I think there's like a barrier of people looking at it of, hey, like, I'm a tenant. And I mean, look, we're in the laundromat industry as well. We can honestly say we do not have a good landlord. Every single landlord that we have is like, they have owned that for families, owned it. It's, you know, passed down to the next generation, and now the kids own it, who definitely do not appreciate it other than a cash cow. And they don't take care of it the same way. You can tell. Even if they do kind of take care of it, they're not negotiating with you. They don't care. They're going to, it's just, they're not looking for you to win. They're just looking for you to pay rent.
Yeah. Which is crazy, because this is, especially as we're in the digital age more and more, and AI and all these different things that are coming into the market, you know, even our cousins in the restaurant industry, they always have people coming in and saying, hey, I never knew you guys existed here, right? There's no more of this, there's community, word of mouth, obviously, if a restaurant's good, or if you know, let's say a shopping center is really good. There's a reason why people go to Whole Foods. There's a reason why people go to Stop and Shop and ShopRite. But there isn't any more, like, if I come in today, the entire community knows about it, right? It takes time for people to realize that you're there. But marketing in the digital space now, it helps you just accelerate that faster and faster.
And there's a lot of things that you can do. And I mean, in all seriousness, like, I look at strip centers and I look at them like, you never even I mean, the one literally that I'm getting, it's the Google profile for the strip center has not been updated for like 12 years.
That's crazy.
Like, what are you doing?
Yeah, 100%.
Like, we're talking 5 minutes, maybe.
Yeah.
Am I wrong? Like,
yeah,
you know,
yeah.
Don't get me wrong. You have to do all the approval crap and all that, which is going to take, you know, a good time. But still, it's, you know, updating Google, maybe having, I probably wouldn't do a social media account for it.
No.
But you can highlight it on your social media account that's for your business, that is the ownership of it.
Yeah.
As well as, you know, just making a landing page so that it's on Google. Again, something else to click on, something else to get traction. And hey, this is what's in here, even if they don't put themselves on Google, which again, you should just, that's one of those things. It's like, why don't you say, hey, do you guys need help doing this? Here's a video. Like, I'm a landlord. I can literally just go on Scribe and just do a quick run through of here you go. And you can just send that email to your tenants.
Yeah, 100%.
So you're like, here, update your Google. It will help traffic to your business.
Yeah. Or even a bunch of the tenants coming together and potentially, sharing marketing dollars together and saying, hey, this guy gets 4 videos, this guy gets 4 videos or whatever. But because if somebody shows up at a doctor's office and goes, oh, I never knew this restaurant was here, or comes to the restaurant and goes, oh, I never knew that grocery market was here. You know what I mean? It's just you're bringing eyes to the location,
It's all about relevance, yeah.
And if you have clean, you put out a good product, and then your businesses are putting on good products, and everybody cares. It's just a whole nother level of understanding and how you can get it out there in public and drive traffic. And we're talking organically here. We're not talking jamming marketing dollars down to get it in front of people's eyes. We're just
1,000%.
talking organic traffic.
100%. And so we got into marketing. I really want to talk about this project that you got that you have coming up. And so it's in Princeton. We talked about it a little bit, but how does somebody get involved into investing into properties, and what they should be looking out for, and in the sense of, you said like you have, investors that go into like flipping, fix and flips, and it's a quick cash, right? Or quicker cash. It's not always quick cash, but in a project like this where it's long term, you're parking your money and you're waiting on that return of investment over the 3 to 5 or 7 years, right? Why is this something that you're very interested in? Why like a longer investment over a fix and flip? And I know you've done fix and flips and stuff in the past.
Yeah, and it's appetite. And for me, it was, I've only, of my holdings, I've probably only sold about four properties ever, not counting primaries. Like, it's just, we like that hold aspect, because if you hold it for that 5-year term or 3-year term or 7-year term, there's a lot that you can do to fix the property. There's a lot you can do to give a better project. You can run systems, you have data, all of that stuff for 5 years plus. But from an investor standpoint, let's get back to staying on topic on that.
Yeah.
You're looking at it more of, you're parking money, but that money's growing, and it has multiple ways to grow in being in a property like this. It can grow from the appreciation. It can grow from the cash payouts that you get will most likely not catch up to depreciation until year 3. Even if it does at all, that's only if you keep it normal depreciation. And that means the money that you're getting drawn out on a quarterly basis is tax-free.
Gotcha.
Pending your tax situation is the proper way, I guess I can say.
And as those businesses start thriving and growing, I don't know, correct me if I'm wrong, but the more revenue that's driving through that property, the more value it has, correct? Because it's commercial?
Yes and no.
Okay.
So, yes, because it's a thriving center and the tenants are staying. The value just goes up every year when the rent goes up.
Okay.
That's how it's going to go up.
That's it?
That's really it. And then the only thing that's also going to drive that is if you continue to put a really good product on, it's extremely busy, businesses are thriving, you're going to be able to exit the property at a better, what they call cap rate, because it's a better property and you're running a very clean operation. Like, think about it. Like, if you went to buy a business or you went to buy a property, they have systems in place. They have, they have a landing page. They have a nice Google. Everything's already done for you. It is like a turnkey operation versus you're going to buy something that's in shambles.
Gotcha.
It's like, if you can have a very clean product, it's the same thing. You're going to get a better price for it. So yes and no, like, obviously good traffic, but rents are going to keep going up. At the end of the day, really, it's just your net operating income is what's going to drive your sale price. But there are some factors that can go in there to get a little bit better bonus on there and a little bit better multiplier because you're putting on a better product.
Gotcha. What do you say to like? I guess this would be to more appetite of investment, but for someone that's trying to invest into, let's say, a stock market, and they're able to pull their money out in 2 months or 3 months from now, right? And a real estate investment, why is it, what's the
Differentiator?
not the differentiator, like what's the bigger benefit of like going into real estate?
So it is diversification as well. So there's a lot of people that want to get into real estate that they don't have time. They don't have the ability, or you can just circle back again on time, but it takes a lot of time to learn this stuff. You can't just, you can just walk up and buy it and just roll the dice and hope that it's great. There's plenty of people that did that. That's a lot harder in this market, like we talked about, especially in New Jersey, just because it's gotten, over the years, it's so hard to get into it.
Yeah, especially with the new builder rules.
Yeah, and there's a lot of barriers to entry to get into this stuff. But the appetite for it is, it's a diversification, and you're still getting the tax benefits of real estate. And yes,
there's no tax benefits in stocks.
No, no. But like it is risk reward. So it still comes down to like your risk tolerance, where people may be like, hey, like I don't like taking any risk at all. I put my money in bonds and CDs. Okay.
Yeah.
Well, that's fine. Well, hey, I'm going to put it in, I want to have some in stocks. I want to put some in real estate. It is that balancing of the portfolio. I want to have crypto, that, like little life insurance. You have all these buckets to put stuff in.
Would you ever accept crypto for payment for?
You'd have to convert it.
Yeah,
yeah. Like I can't take Bitcoin or XRP, as an investment. But what this is like, the way that we have this set up is a real estate syndication, which basically allows accredited investors to invest in your project, and they can make a return based off of, you have your projections, but again, it's not like we can guarantee anything, but like we've put a lot of time and a lot of scrutiny on those numbers to make sure that they were at a level, at a risk tolerance that we were happy with, where our risk on this opportunity is we have three units to fill. The grocery store is almost done with its build out. Once that's done, the academy's in. Those units we're going to fill up relatively fast, and we have it projected for a long time.
And are you looking for specific tenants, or like what's the difference? Because I know some people take in anybody, right? And then there's a lot of people. It sounds like when I was on the project with you last year, and we filmed a couple of videos, you were very you met with a couple tenants, and you were really just doing your due diligence before allowing them to even sign a lease. So what's that process like? Like, who are you looking for? Is there a certain type of tenant that you're looking for? And who are you turning away if somebody comes and asks you to, hey, I'm interested in leasing this office?
It is always going to be tough to rent to a first-time business owner. And it's tough.
Yeah.
You really don't want to, unless they're going to come at you and be like, hey, I left my Wall Street career and here's my personal guarantee. I have $10 million in assets, and I'm going to rent your 1,500 square foot space for my exotic rock store that I'm going to have. And you're like, oh, okay, you could have that. But,
Yeah.
No, but
as long as I get my rent.
Yeah. But at the end of the day, like, you do want, it's the community. So like we're looking at that as like, what's a good mix for that community?
Gotcha.
And that is something that we were very, we were looking at what tenants would be a good fit, talking to some potential tenants, and just, we have like our, who we want in there. And I feel like,
So on the investing side, is there certain qualifications to be able to invest in something like this, or like can anybody kind of invest?
So you do have to be accredited, because you are essentially buying a security in the property. That's the way that the verbiage, and if you dig into all the nitty-gritty lawyer paperwork that we do have to do for all of this, you're getting an SEC exemption. So with that, you have to be accredited, so you have to meet those guidelines, which they just changed again, and you do have to constantly pay attention to that. But basically, if you make a lot of money and have disposable income, generally you're accredited.
Is there two different ones? Because I've seen like syndications in different states that you can invest any type of money into.
Yeah, so there's a 506B and a 506C. 506B you cannot market, and I could not come on here and talk about an opportunity that was a 506B.
Okay.
Because what that is that's friends and family for investing.
Only.
Yes.
Okay.
And people so you have to have like multiple points of contact, and there's plenty of lawyers that talk about this online stating like you have to be very careful with how you do that.
Gotcha.
And that was where like when we first engaged and we were like, hey, like we're thinking about doing this, and you're like, oh, we got to blast marketing. I'm like, no, like we cannot. I have to go through.
You don't understand. I'll go to jail.
Yeah. Yeah. It's like you have to go through this whole process with the lawyers and get all the paperwork filled out, get everything has to be filed. It has to be, we did everything, went through the whole process, and then it's like, okay, yes, you can now market. Everything is clean. We've signed off. They've reviewed all of our documents that we put out, and they said, okay, you're good to go. You can market.
So when you're investing into these type of properties and you have a certain level of disposable income to allow you to be accredited, what are you looking for on returns? Like as an investor, is it, is there like a benchmark of or is it just does that go back to appetite? If somebody says, hey, projected returns on this opportunity is 7% or versus projected return on this opportunity is 20%, how do you gauge that? How do you look at that stuff?
So there's different ways to look at it, of course. Like there's, I'll kind of break through the different types of returns. So you have a preferred return. So your preferred return is a percentage that's going to accrue on the deal no matter what. So if the deal only paid you out 5, but you have a preferred of 8, until it's going to accrue, saying that you have to be caught up to that 8%.
Okay. Before
you would go to any other tier of returns. But there's internal rate of return, which is what that's counting like when your cash is coming back to you over how long the period it takes you to get that cash back. That's what
So if your IRR is 25%, then you get it back in 4 years.
Well, yes, that is exactly how it is, but it's still like that 25% might mean you get all of it at the end, or it might mean you get X amount for each year.
Gotcha.
That's why that's like, you got to watch, IRR is great because that's your exit number that everyone likes to say like, oh yeah, 25% IRR, but you're only getting paid when the property sells or refinances.
Gotcha. So if they don't sell for 10 years, then you're damn.
I mean, if you're getting a 25% return, do you care? Yes and no. It matters if you were expecting that cash back or not.
So now that really makes sense why the SEC is all over this thing, because I'm sure there's been other companies that kind of finagle the contracts and the writing and, oh, well, no, if you read on the contract, it's actually when we sell the property, not.
Yeah. And I mean, that is all, you have to disclose everything. So, like in the way that you do it, they call it like a waterfall, but we'll keep going little by little.
Yeah.
But so then there's like a cash on cash return.
Okay.
So the cash on cash is about how much cash you're getting paid each year. So let's say, you got $100 in the project, you're getting $10 a year. You have a 10% return.
Gotcha.
Simple. But like that is the return of how we like to use that metric, is we look at that as that's the cash flow the deal's producing. And that's how much it's actually paying every year.
Gotcha.
So if you have whatever events you have going on in the deal, either refinance or, there's whole, there's a lot. So let's just say like a capital event, any type of capital event, you'll see if it's projected, like you'll have a really big return that year, but then it kind of goes back the year after.
Gotcha.
So it's like that, the cash on cash return is just a good way to look at that as that's my general cash flow that I'm getting from the deal.
So your goal in that 5 to 7 year period is to get your investors paid back their initial investment and maybe some, right?
Before it's sold.
Yeah, before it's sold.
Yeah.
And then from there, that's all straight profit. And they keep a percentage ownership in the property.
Yep. So
unless they want to sell out. Can they sell out?
there are rules to doing that, and it's all disclosures, and it's determined by the disclosures in the deal.
Okay.
So generally your money is locked that is the rule. Like you are locked for the deal.
Unless you like sell the building or something.
Yeah, unless we sold it. So
Gotcha.
the aspect of like looking at that of just, it is, like I said, like people will look at deals in different ways. It's like, hey, what's the actual cash flow that I'm getting from the deal on a yearly basis? Which what we loved about this opportunity was that it has, after the first 2 years really, because that's still your lease up period, it kind of really revs up as a really good cash flow property for the next, 2, 3, 4 years of the hold. It is a good cash flow property. So you'll be getting a nice check every quarter. And people do like to see that. It's obviously like you like to get, hey, here's your email. Congratulations, you're getting paid. Like not a lot of people are mad.
Yeah.
Investors really do like getting paid. I can tell you that because, from being, generally the bearer of good news, but, on anyone's journey, you're going to have a couple bad ones. And, at the beginning, I could definitely tell you, when you're taking more risk, you're taking risk on stuff that you didn't need to. And there are some duds in anyone's, if you haven't taken a couple losses along the way, but like, that's not the news you like to give people. You like to really make sure that, hey, it's, we get the payout and, you're paying people out on a Monday or a Friday, everyone's happy,
Yeah.
And I think that with your accounting background too, it's you really know how to nail the realistic return projections and all these different things.
Like the expectations.
Yeah, the expectations. Whereas I know there's a lot of companies out there, not just in the real estate space, but in any space, they overpromise on everything.
Yeah,
right?
like my wife and I are extremely conservative when we're doing anything because that's how we've always done it. And, it's not like we're looking for the home run.
Yeah.
Like I want to be able to say, hey, this is the window of return that I want to give. And this is the window of return we are conservatively going to hit.
Okay.
And look, if there's outside factors that weren't, there can be always outside factors.
Right.
But if everything is going relatively close to anywhere to normal, this is what the return should be. And we are trying to, basically under promise over return. Like that.
Gotcha. Well, you also build yourself a reputation because you knock this project out of the park, right? First of all, your pool of investors are going to be like, holy shit. And they're going to be very happy and say, hey, Nick, what's the next project you got?
Yeah.
Right? And then they're going to tell their friends, and then the second one's going to go up, and then you keep doing that over and over again. You build a massive client base where you guys are all winning, right?
And that's like kind of where that, it's like you're asking like how you get here, and it's like that was just the vibe that you kind of lose that in corporate, especially in accounting, or even if you're running your own business. It's like you have to look at it as, is the community winning?
Yeah.
And that's how I run all my small businesses, and that's how my wife and I looked at this, and we said, you know what, if every other week we're having people ask us, hey, how can I get into real estate, or how can I do it? Well, let's build a business to provide opportunities to invest in real estate.
100%. I feel like also this is a great vehicle for someone that's, instead of buying a house in today's market, renting and taking that $100,000 deposit or $200,000 deposit on that home they're looking at and investing it into a commercial space and having that asset pay them back over time, because like right now a down payment for a home, a down payment for a home right now is like $100,000, $150,000.
You have to look at a home though as a liability.
Yeah.
Like as much as it's still an asset. You can play games with your primary and you can make money from being in your primary, but generally it's your liability. That's your cost of living.
Because you live in it,
yeah.
It's your cost of living.
I mean, we're in an apartment right now in Somerville, and you have, your fridge goes out, the ice machine doesn't work, the laundry equipment stops working. Hey, can you come fix this? No problem. Do you get charged for it? No, because it's on your lease, right? With a home, you got to cut the grass. You got to make sure things are working. If the plumbing goes out, that's $15,000. If the lights go out, you know what I mean? There's so much unforeseen expenses in the home world, and I think it's just been this propaganda of brainwashing people. Oh, that's the American dream. That's the American dream. You own an asset. You own an asset, but whereas it's just money coming out your pocket.
I'm telling you right now, we were very close to renting, and you're talking to people that have plenty of houses. Like we were looking at it and we're like, do we just not buy another house? like we sold our primary and we're sitting there and we're like, you know, maybe we just don't do that. And then we're like, you know what, like we'll just we'll get one more. All right, it's fine. But then you get to do your own stuff. You get to have it, and you're accepting that it's a liability.
Right. It's more of I think like a more emotional thing.
Yeah, like this is like, hey, like we now have an 8-week-old, like.
Right.
We're going to get this house. We're going to just grow up here and it's fine. It's around the corner from some of our friends. Right. We're going to have a good time doing it. You know?
Yeah, absolutely. You need that as well.
Yeah, like it becomes a hobby.
Yeah.
You know, you get to build what you want. You get to have the life.
Gotcha.
You build it around that aspect. Like if you use your home as a performance environment, like that's how I've kind of viewed it at this point. I've moved 4 times since I've been 28, you know, and it's just, we're looking at it as like, all right, if I'm going to go put an office here in my garage or like above my garage and have like a separate office space from my main house, like I know I can get a lot of work done there and I'm going to be in a really good work environment to perform at a really high level.
100%.
So if you look at your house that way, that's how it's like, it's a different viewpoint to look at it where, you know, it is nice to be proud of something.
Yeah, absolutely.
Yeah. And I mean, it's fun. Doing home projects is definitely a time suck, but
but it's yours.
I guess what I meant is like on the investing side, if like you were interested into getting real estate.
It also matters, and like this is where, you know, definitely there's different perspectives of life. Like there are people that when they feel like they're performing, they want to take on more liabilities and increase their lifestyle, and that's perfectly fine. Whatever floats your boat. But at the same time, like you're saying, you can actually get ahead now in life now. If you're looking at, hey, I'm going to keep my expenses as minimal as possible. Mm-hmm. I'm going to go live in that small apartment because this is all I need right now. Mm-hmm. You know, it's like I'll go rent my office space so that I can go work there and I just have a small place where I live and I don't have to worry about anything. Something breaks, I just call somebody and I know I have fixed living expenses. Yeah. Where if you own a house, you do not have fixed living expenses.
Oh, no way.
Yeah. So it's like, it's just a different way. It's like, how much do you want to suffer while you're in your growth phase to get ahead? Yeah. Because if you're going to like basically live in an apartment, let's say for an extra year or two, and then you're like, okay, well now my business has now grown 3 to 5x because I had more time to work on my business. And that's the same way where we look at it as like, well, I want to have more time to continue working on my businesses. So we were like, well, I'm not going to live on this, 3/4 of an acre lot. I'm going to move to a smaller lot, but closer to the beach because we know we enjoy being by the beach. Yeah. And that's going to bring our balance so that we can perform better. Yeah. And that was our strategy with purchasing another house. It was literally like, where are we going to be happy so that we can perform better and, be able to handle more, working on deals like this, which, I mean, all of this stuff is incredibly stressful. Yeah. And you got to put, 80 to 100 hours in a week to get this stuff done because you're always on a time crunch. Yeah. It's like research deal, do all your work. Okay, green light, go. My deposit's in. And you're looking at it and you're like, all right, well, I just fronted a deposit on a $12 million deal. Like, oh, well, I have to do a lot of work now. It's like,
isn't it supposed to work the other way around?
Yeah. But no, it's like that's where, you're kind of getting in on this stuff. And like, that is a crazy way to take the leap. Yeah. Is like, when you send that wire transfer.
And I think with you guys, especially with, with Freedom Acquisition USA, it's you guys are very knowledgeable in what you guys do. You and Nikki are like, you guys are experts. Nikki has wrote a book, And
she won't tell you that.
Yeah, she won't tell you that. She doesn't want to sell the book.
No.
But I think it goes to show you that because I see the demographic for you as the person that wants to get into real estate, that has exposable income, that wants to really get into it, doesn't understand it, but can find people like you that will be able to help them, grow their money. Right?
And essentially that is right.
Yeah. And also at the same time, learn about the industry, right? Mm-hmm. Because it's a lot harder to do it all yourself, figure out, the ins and outs of real estate. I mean, our mom's in it. She has 4 properties right now, and she learned a lot. She had a lot of setbacks, a lot of good times, and she just had she had her home run. She got approved for a subdivision. So it was one lot. It used to be subdivided, and they put it together, and then the paperwork was not fully through or something, and they just went to the town and finally got it approved. So now she has a whole nother lot that she can kind of build up.
Build or sell.
Yeah, build or sell, and that's a home run for her. But people don't realize that you just said you put a $1 million in. Now it's time to put the 80 to 100 hours of work. Not everybody is one, willing to do that, and 2, have actually the time to do that because they have their day job and whatnot, right? So it's how do you get the best of both worlds? And then the second thing,
it's a lot of suck.
Yeah. Yeah. And I think the second thing is, because before I even go to the second thing, I think the lot of suck part that you just said is the properties here. People think as soon as a property goes onto the market, because houses are being bought at $100,000 over asking, it's like, oh yeah, I'm going to get this thing and I'm going to rent it out. And then they come to realize that, oh shit, I'm only cash flowing $200 a month, right?
So you're not.
Yeah. So, but I think going to the second part is it also for that busy business owner, whether you're a small business or a large business, you have disposable income, and it's, hey, I want something as an investment vehicle, but I don't have the time to do it. This is perfect, right? I don't have to learn real estate. I don't have to learn about all the numbers and project any futures or what I'm going to get on the return. Let Nick do it. Let Nikki handle it, and there you go.
But this is where it's you have to build relationships with people or have a good reputation and work with people and build that trust factor. And that's what we're looking to enjoy that process. That's what I've enjoyed doing that with friends over the years, doing business and doing smaller deals and stuff. And, even going up into the little bit larger deals where, you do $3, $4, $5 million deals, and then you get the cash out and you feel pretty damn good doing it. Yeah. But the point of this is creating that vehicle, and it's an alternative investment. You just, like I said earlier, it was it's a different bucket. And the way that we've set our platform up is you'll have all the analytics on everything. So it's you have an investor portal where you can sign in and you're able to access a lot of information where you can go and mess around on that and learn that, and you don't have to pay for that software.
Yeah.
That software is just what we offer with our platform to learn about the investment
100%.
And to track the investment.
Yeah.
So you'll have access to all that data, and that's that kind of stuff is great to learn on while you're getting into real estate more and more, where it's hey, I have this disposable $100K. Well, what are you actually going to do with it? Are you going to just go buy a rental where are you going to answer the call at 3:00 in the morning if the plumbing's broken?
Yep.
Because who else is going to answer? You don't have a property manager if you want property.
Yeah.
And that's just where you got to look at it.
You don't have a property manager at 4 properties.
Yeah, well, it matters who you are.
Yeah. Or what size of,
Yeah. It does also matter what kind of stuff you're trying to get into. Yeah. That's it.
But a busy business owner, they don't have the time to do that, right?
No.
I mean, unless you're in the construction space or, a contractor or something, totally get it. That's different. But for someone that's, let's just say, owns a restaurant, is making a lot of good money, they want to invest into something. They don't have the time to pick up a phone call on a busy night and be like, yeah, I'll be right there to fix your plumbing,
Yeah, or even I'm going to call someone that's going to give me a quote. I got to call 2 people to quote it and then get someone to unlock the door or talk to my renter to give 24 hours notice for a person to come. You know, it's like you have all those issues, and this is the true definition of passive investing.
Yeah, 100%.
It is very similar to just, you know, if you just dumped your money in the stock market for 5 years and took it out and didn't look at it. You just put it in mutuals.
And I think the other thing is social media platforms have kind of gotten people used to that quick hit, you know?
And that is, yes. that is definitely true. Like, you know, it's like, oh, wow, I did this drop shipping thing, and overnight I did $40K a month. All right. Well, good for you.
How'd that work out? Right?
Yeah, how'd that work out? Yeah. No, and I mean, like, the thing that we love the best is, like, you're running a business. And that's something that, you know, already running multiple successful businesses and now being able to take a step back and looking down on them and how they're performing, making those adjustments, that kind of experience as well does tie into this. 100%. And that's what has really enjoyed us, is like you get to build a business, and your business is providing real estate opportunities for other people.
That's awesome. And I think the other thing too, to just add on to that, is, you know, you're giving these people resources, right? So they're learning as the process goes. Mm-hmm. And if they're making more money and they want to invest more stuff, teaching them and giving them value back over time, they might come to you and just say, hey, Nick, I saw this other opportunity, right? What do you think about this one? And now you guys have a pool of, you know, equity owners in the real estate game that it's like, hey, everybody, do you guys think it's a good idea to get into this investment? Well, I put this and this together, it looks good. And now you have this whole other opportunity, right? You guys are growing together.
Yeah, and that's like, you do build a little community, and that's what you can see. A lot of successful smaller groups have done that, where they build a little community around what they're doing. And it is something that we're looking forward to doing now that we're able to offer this. And I mean, the docs that we put together, we have had to, you know, we send those out to a lot of friends and family before we actually get them public, because they're you have to kind of get them to be palatable. Yeah. Because if we just took our underwriting and handed it to everybody, they would just look at it and be like, well, there's about 1% of the population that knows what's going on here. You know, it's not for everybody. So that's why we try to put it in a nice, like, palatable way to say, like, hey, like, here's the breakdown. If you invest this is what, you know, this is the way that it's going to flow out from our projections right now. Gotcha. And it's just,
run us down through this project. Like, how does somebody get involved into investing into this type of property, and what's the whole process?
Okay, so I'll talk it through as if, you know, not from our perspective, more like from an outside investor. Yeah. So the way it would basically be, it's like we have an offering memorandum that with that is just, that's the, like, short summary of kind of the high level overview of the deal, which is, that's the very, very easy to understand document. That's the first one that we put up on our website, just to, you know, just kind of walk through and be able to understand that. And then the next one is the executive summary. Okay. And the executive summary goes a little bit deeper into the project, a little bit more into the weeds, gives you a better breakdown, more information. And then if you want to continue with even more information, then we have our investor portal where you would make an account on, and then you just set it up there. And even there, that's more paperwork, more information, more breakdown of, you know, how the whole operation works, and all the extra documents that go with that, you know, for the from like the actual SEC lawyers and everything. So
gotcha. What are some, like, important metrics or just language in these documents that, hey, I'm going to read these, right? And this is what I need to understand of what I'm getting myself into, and how my money is going to work for me.
Mm-hmm. And, you know, hitting that point of, like, how is my money going to work for me? Like, that's exactly what we're trying to do. It's like, you create the vehicle for that. And the metrics you have to look at is going back to, like, the appetite that you want. Is, are you looking for, hey, how much is my money making year over year? Or are you looking for, how much am I going to actually have hitting my bank account year after year after year? Because gotcha. Those are different metrics. And that's where, if you want to look at the overall return of everything, that's your IRR. That's going to be what your true return is at the end of the deal.
Okay.
The preferred return is that 8% return that we have, which can be whatever the deal's set at. The preferred return is that's what's accruing every single year. So no matter what, that 8% is getting charged basically to the deal, to the investor pool.
Gotcha.
That's just a good way to look at it. It's like, that's like your CD payment.
So that's like if you're investing your money with a financial advisor and they're like, look, worst case scenario, you get 7% return every year.
Basically, but it's actually even more like a CD or a bond.
Gotcha.
Like, it's just like, here's that return. That's what's going through. And unless the deal goes underwater, that is what your payout's going to be.
Okay.
The cash on cash return is what the projected actual cash flow of the deal is.
Okay.
And that's where, taking into, capital events as well. So that's your refinance or, secondary debt and sale. That is where those returns are going to look into. So that's definitely something to look for your appetite. But the thing is, it also comes down to is risk.
Mm-hmm.
And there's going to be people that want to, essentially risk it for the biscuit, and they want to go on those deals that are like a heavy lift.
Yeah.
And you look at and you can look at any of those offering memorandums or executive summaries and say, oh, is this a heavy lift, or are they just, buttoning up the property and making it pretty? And this is one of those, we're basically just buttoning it up, and there's no capital, there's no big capital projects, there's really not a lot of anything here. It's really just a lease up. So you're going into that category of where it is a much lower risk tolerance. So that is something you want to look at as an investor, is the actual risk tolerance of yourself, of like, what are you looking for? Because there's different opportunities where you could go and invest in, say, a real estate fund, where they are just going to do, let's say, anywhere between 7 to 10%, and it pays out monthly.
Gotcha.
And that's your return.
Gotcha.
But then you don't get the upside. So here, this deal is available for upside. Okay. So, if the deal makes 25, 26%, that's what it's there for the investors.
So for someone, that has, let's say, $1 million, what can they kind of project with this type of investment?
So on this first opportunity, we're looking at about 25% IRR. So that's basically over 5 years, 25% average a year that's what we're projecting for that. And cash flow does differ each year because it builds up, and then after the lease up period in the first 2 years, you would have a cash on cash return, which the metrics change by the timing of the lease up. And so the main thing you would look for that is the 25% on the exit. That's what we would be looking for.
And the exit is either the refi or the sale
at year 5. Yeah,
okay.
That's what we're looking for. I mean, realistically, we have it pegged for a sale on the property because it has a lot of good rent increases between year 3 and 5 on a couple of the tenants that we're trying to capture. And then that's why the sale on the property, it makes sense to sell this property because you get the investors the most money.
So if I'm putting down $1 million, I should see somewhere around the ballpark of 1.25 at the end of the 5 year
return.
Yeah, return.
Yeah, return.
That's crazy.
On top of the capital.
Yeah, that's pretty.
That's massive.
No, it is.
You ain't getting that in the stock market.
Well, that's definitely not true. Yeah, it matters.
Maybe in crypto.
No. You can get that in the stock market. It just matters who's playing games for you.
Yeah.
But no, it's like it's also like it's a different type of investment. If you are investing, you have to remember that when you are a passive investor, you're a passive investor. That's something you have to be okay with. Some people love that.
Yeah. You ain't calling the shots.
Yeah. And then, but that can go in two extremes. You can be a passive investor, and there's guys, mentors and people I've worked with, been coached by, they're like, there's a couple of guys that he showed me. He's like, I have a guy, he's in 38 of my deals. I have never gotten a phone call from him after I onboarded him.
Yeah.
He doesn't care.
Yeah.
He's like, this is great.
Yeah. Yeah.
He's just, he's just in the passenger seat.
Yeah. And then you have people that put, 50 grand in a deal and they're calling you every month.
Yeah.
But it's just like you have to build systems and processes that have really good communication.
Yeah.
And that's something that, it's like every mentor, coach that I've worked with in this space to get to where we are to be comfortable to offer this.
Mm-hmm.
That's one of the main things they talk about. It's have the good emails, get on the phone if you have to, or run. Like we have it spec'd on our opportunity to run quarterly Zoom meetings.
Yeah.
Which in all seriousness for TripleNet, after it's leased up, our Zoom meeting can literally be done in 2 minutes.
Yeah.
Hey, everybody paid rent for the last 3 months. ACH is coming. So you got, and it's like, no, it's like you don't have as much to talk about. But
right,
like still the point is you engage with investors that want to engage with you, and you just make that part of your core values.
Yeah.
And like that's where it's like, being personable and being, as much as we are like like to be in the weeds, and preferably in a perfect world wouldn't have to come out and talk on podcasts or, do any of that stuff. Yeah. It's like, we'd be perfectly fine just living our life, doing that kind of stuff. But it's like, you got to put the face out there and actually like, it's almost like having pride of what you're doing.
You're building your brand.
Yeah. I'm building a brand by not wanting to build a brand. Yeah. No. It's good though. Like at the end of the day, like it's going to go with who I am and how we want to do it. It's like, I would rather communicate with people. Same thing in business. Good times or bad, you never change the communication.
Yeah.
Like, true. I mean, hell, I had a call this morning. Hey, sorry, all your equipment for your delivery tomorrow, they called me this morning and they back ordered everything and it's been paid for. And I'm like, it'll be here in a month.
Yeah.
They weren't happy, but you have to be able to just make that call and not just send an email.
Right.
Yeah. Call
it seems like even with the building a brand aspect of it, there's also a lot that people could learn from you as well. Like, a thing or two. It seems like you really do seem like or you've been in it for so long. Just secondhand, just being on this podcast, just listening to you speak about it. I mean, like I've learned a thing or two today.
Very passionate about this. It's we love the aspect of doing everything from involved in real estate, and there's a lot of good, bad, and ugly that comes from it. And there's a lot of people that'll look at you and be like, oh well, like why are you doing this, or how are you qualified? No, like there's plenty of people that just were a face on the internet and then they went and did it, and they, good or bad, they did it without accounting and finance backgrounds, or they had to bring someone on to do that, or, so like we built our core team, which is one of my mentor in this is Lyndon Hansen. He's actually not even in the state, but it's still like he's done over 400 million of transactional volume. So that's a big number.
Oh yeah.
And he runs a lot of deals on the asset side, and we kind of went through his experiences, how us working with teams doing underwriting and asset management as well. Like we looked at it as the main weak point in a lot of this stuff is the communication, the actual people doing the accounting, because my God, are people terrible at accounting. And this is generic. You have to remember, like you have software, and if you just set it up right, generally it's not even that complicated. This is like low level accounting. But still, it's like there are aspects that happen that you do have to be very careful with, and have good accounting skills. But it's there is very poor bookkeeping and very poor timing on taxes, and getting stuff out the door at tax season is crucial for investors. Because think about it, like if you're sitting here waiting for a tax document and you have to file an extension because of one document, because of one investment that you're in, and I'm sitting there and I'm like, I'm so used to being geared for year-end closes from finance and accounting that, you just do everything the first couple weeks of January.
Yeah.
As I say that, in this year, I definitely didn't, because we had a kid. So I'll say I fell off the rails this year. So
how many kids do you have?
the first one.
Oh, that was your first one?
Yeah, that's the first
wow,
one.
Dude, congrats.
Yeah.
Well, how old?
She's 8 weeks.
Oh, no way.
Yeah.
Oh, congrats, dude.
New dad.
Yeah.
I didn't realize.
New dad here.
That's awesome, man.
It's like, so, everyone, you're sitting there and like we joked about it with a couple other, the big real estate people. We went to a couple conferences and one of the other husband and wife groups was like, oh yeah, we did that too. They're like, yep, moved houses and had our firstborn and did our first big syndication deal all at the same time. I'm like, it's like, why do we do this to ourselves?
Well, it puts the pressure on,
No, it does. And like, honestly,
We'll make the
like,
next one easier.
oh yeah.
Yeah.
And I mean, like we do have a second already teed up for the fall, but it's like, you got to get through the first one first.
Yeah.
And the first one having the speed bumps that it did, the amount of learning that I thought I had and like how much more you learn going through, because like I've been through good situations where it's like, hey, you're on the asset management team. I've done all my own acquisitions, but being on the asset management team, you only get a little bit of what's going on with the speed bumps. You usually get it secondhand.
Yeah.
And like being there, being able to like sit in the driver's seat and do it yourself, and also realize that we were doing way more work on the asset management side than like the underwriting and asset management was a lot of work because we did like 90% of the same work that we've done for other people, except we did it for ourselves. And I was like, oh, okay, like we're good. We've been down this rodeo before. We've put a few offering memorandums and executive summaries together. So you just get to brand it with your own stuff this time.
That's awesome. That's awesome. Anyway, so let's just wrapping it up, I guess. It's if somebody was interested into investing, where can they find you? How can they learn about the project?
Yeah, so I mean, you can come through either Instagram. For me, that's just NL Fusilli, easy, or Freedom Acquisitions USA is our that's the Instagram handle, and website is freedomacquisitionsusa.com. And under there we have offerings tab, and in there you could just download everything. It's all there for the public to look at, and or just reach out. Just DM, shoot an email. It's all on the website. So more than happy to, you can schedule a call on the website. It's fine. We have, we just have auto bookings. Just go on, jump on the calendar, and our team will jump on with you. So it's we're really looking forward to continuing to grow this, and working with you guys as well for
thanks, man.
Thanks, man. Appreciate it.
working
Likewise.
with you guys for it, because it's like there's everyone and their mom's using an AI generated crap marketing, and we can raise capital for you and do this and this, and I'm like, what are you talking about? By the way, like half the stuff that you just offered me breaks all of the guidelines saying that you're not supposed to do. It's like it's like you sit there and like listen to all the lawyers. They're like, do not do this, and they're giving you a list, and half the things on the list are like, dude, I can't do those things.
Sometimes I feel like that on the social media side, people just want to sound sexy, or they partner with a marketing company that they don't do their due diligence. They just add the marketing to it, and they don't really know about it. But that's why I think we like to really understand the industry and the person that we're working with, because that's crucial, right?
Yeah.
I mean, the last thing you want is a lawsuit or any type of violation, because that could screw you up big time.
No,
So,
it would ruins the entire career. And I mean, like, like the selfish plug going to you guys is like, before we got on this, it was 5 different people referred you to the same person.
Yeah.
So you're doing something right.
Yeah,
Thank you.
But thanks for listening, guys. It's been a pleasure with Nick Fusilli. Again, freedomacquisitionsusa.com. If you guys are interested in investing, like, subscribe, and comment, and we'll see you in the next episode.
Sweet.
Cool.